The IRS is not going to call you and tell you this. Your tax preparer may not bring it up unless you ask. And the person sitting next to you at the doctor's office, at the grocery store, at church, they almost certainly have no idea it exists. But right now, in 2026, there are 7 completely legal confirmed strategies that Americans, especially seniors and retirees, can use to pay significantly less in federal taxes. Not loopholes, not schemes, not anything that requires a team of accountants or an offshore account. Strategies that are written directly into the tax code, confirmed by the IRS, and available to ordinary people on fixed incomes who have simply never been told they existed. Today, we are walking through all 7. What each one is, what it saves in real dollars, who qualifies, and the exact action you take today to make sure every single one of these strategies is applied to your 2026 tax situation before the filing deadline passes and the opportunity closes for another year. Stay with us, because at the 6-minute mark, we are going to show you how combining just 3 of these 7 strategies can legally reduce a senior's federal tax bill to 0. And that combination is something most tax preparers are not building for their clients unless the client specifically asks for it. Which city and state are you watching from right now? Drop it below immediately. Because state taxes interact with every single one of these federal strategies in ways that are specific to where you live. And I want to know exactly how many people in this community are currently overpaying taxes that these strategies would legally eliminate. Your city? Your state? Drop it in the comments right now. Here is strategy number 1. The one that is already law, already in effect, and already being missed by the majority of seniors who qualify for it. The One Big Beautiful Bill introduced a new temporary senior bonus deduction of up to $6,000 per qualifying individual that was enacted when President Donald Trump signed the legislation into law. A married couple filing jointly could qualify for a deduction of up to $12,000. The $6,000 senior deduction is in effect from tax years 2025 through 2028. It applies to taxpayers 65 and over, regardless of whether they itemize their tax returns or take the standard deduction. ARU Web, here is what that means in real dollars. A married couple, both aged 65 or older, who qualify for the temporary senior deduction in 2026, will not pay a penny of federal income tax until their gross income exceeds $47,500. Not $50,000, not $60,000, $47,500 of income, completely protected from federal income tax. For a couple living on Social Security and a modest pension, that number covers their entire annual income with room to spare. Capital Skyline. This 3-year window is an incredible, valuable opportunity, said Miklos Ringbauer, a certified public accountant and founder of Miklos CPA Inc., an accounting and tax strategy firm in Southern California. 3 years, 2025 through 2028. Every year you do not claim this deduction is a year you paid taxes you were legally entitled to avoid. ARU Web, have you verified that your 2025 tax return applied the $6,000 enhanced senior deduction? Yes or no? Drop it in the comments right now, along with your city and state. Because the number of seniors who filed their 2025 return without this deduction is one of the most important things this channel has ever looked at. Here is strategy number 2. The standard deduction upgrade that most seniors are not taking full advantage of because nobody explained how much larger it just became. The One Big Beautiful Bill Act increased the standard deduction to $16,100 for single filers and $32,200 for married couples filing jointly for tax year 2026. Retirees age 65 and older also qualify for an additional standard deduction of $2,050 if unmarried or $1,650 if married. That additional amount stacks on top of the base standard deduction, further reducing taxable income without requiring any additional documentation or itemization. Elmira. Here is the calculation that most seniors have never run. Base standard deduction plus age-based additional deduction plus the new $6,000 senior bonus deduction for a single senior 65 or older in 2026. Those three amounts combined produce a total deduction that shields a significant portion of fixed income from federal taxation entirely. Run that calculation for your specific situation today. Compare it to your itemized deductions. Use whichever number is larger. For most seniors on fixed incomes, the enhanced standard deduction now significantly exceeds their itemized total, and seniors who are still itemizing out of habit are leaving money on the table every single year. Here is strategy number 3. The SALT deduction change that is specifically valuable for seniors in high-tax states who have not itemized in years. The new Tax Act raises the state and local tax deduction cap to $40,000 from $10,000 for single and joint filers for the next 4 years. For seniors who own property in high-tax states, New York, New Jersey, California, Illinois, Massachusetts, and who have been limited by the old $10,000 SALT cap, this quadrupling of the deduction cap changes the itemizing calculation completely. A senior homeowner in New Jersey paying $15,000 in property taxes and $5,000 in state income taxes was previously capped at a $10,000 SALT deduction. That same senior in 2026 can deduct the full $20,000. Combined with mortgage interest, if applicable, and charitable contributions, their itemized total may now exceed the enhanced standard deduction for the first time in years. Run the comparison today before assuming the standard deduction is still the right choice for your specific situation. NerdWallet. Which city and state are you in right now? Drop it below. I am asking again because the state tax portion of this conversation is specifically important, and I need to know where this community is located. Your city, your state. Right now in the comments. Here is strategy number 4. The qualified charitable distribution strategy that simultaneously satisfies your required minimum distribution and reduces your taxable income, and that most seniors have never been told about in a single clear sentence. If you are age 70 and a half or older, you can donate directly from your IRA to a qualified charity. If your R&D is $20,000 and you transfer $10,000 directly to a qualified charity, only $10,000 may be included in your taxable income. The charitable contribution satisfies part of your RMD requirement without the distribution counting as adjusted gross income, which means the QCD reduces your taxable income, which reduces your combined income calculation for Social Security taxation purposes, which may push your combined income below the threshold where your Social Security benefit becomes taxable, eliminating that tax entirely. Giving to a cause you care about, while simultaneously reducing your tax bill and potentially eliminating the taxation of your Social Security benefit, is a strategy that most seniors completing their annual RMD have never had anyone explain to them clearly. OK Diario. Older taxpayers may also consider reducing their taxable income through charitable contributions beyond just QCDs. If you are not yet 70 and a half, bunching charitable contributions into a single year to push your itemized total above the standard deduction threshold, then taking the standard deduction in alternating years is a strategy that produces larger deductions over a 2-year period than giving the same total amount spread evenly across both years. Here is strategy number 5. The retirement contribution strategy that is specifically relevant for seniors who are still working in 2026, and that most people in this situation have never maxed out. Individuals who are age 65 and up and still working may be able to reduce their taxable income by contributing to a retirement plan. In 2026, individuals ages 50 and older may be able to contribute up to $32,500 to a 401k retirement plan, including catch-up contributions. Individuals ages 60 to 63 may be able to set aside up to $35,750 with super catch-up contributions. AIU Web. Every dollar contributed to a traditional 401k or IRA reduces your taxable income dollar for dollar in the year of contribution. For a senior still working, who is in the 12% tax bracket, contributing an additional $5,000 to a traditional retirement account saves $600 in federal tax immediately. That $600 saving is real money that stays in your account instead of going to the IRS. And the contributed amount continues growing tax-deferred until withdrawal. If you are still working and you are not contributing the maximum allowed amount to your retirement plan, the difference between what you are contributing and the maximum allowed is money you are paying in taxes right now that you are legally entitled to defer. Here is strategy number 6. The Roth conversion strategy that is specifically powerful during this 3-year window and that most people ignore until it is too late to use it effectively. One strategy to consider is taking distributions from tax-deferred accounts to get to the top of the 12% bracket, about $148,300 for married filers in 2026. Even if they do not need that money, their effective federal tax rate on this income will be less than 8%. Income above living expenses can be directed to Roth conversions or simply reinvested in a taxable account. Capital Skyline. Here is why this matters right now specifically. The enhanced standard deduction, the senior bonus deduction, and the current tax brackets are all temporary, in effect through 2028. Converting traditional IRA money to a Roth IRA right now, paying tax at today's rates, which are among the lowest in decades, permanently eliminates future required minimum distributions on the converted amount and permanently removes that money from the taxable income calculation that determines Social Security benefit taxation. A Roth conversion done now at a low tax rate prevents a larger tax bill later when RMDs force distributions at rates that may be higher. A tax professional who specializes in retirement income can calculate the optimal conversion amount for your specific situation, the amount that stays within your current bracket and maximizes the long-term tax benefit of the conversion. If this Roth conversion strategy is something you have never discussed with a tax professional, hit the like button right now and subscribe immediately. Because the next investigation covers the Roth conversion calculation specifically for seniors in 2026, with real numbers and real examples showing exactly how much tax this strategy saves over a 10-year retirement horizon. Subscribe right now so it reaches you before the 2026 filing year closes. Here is strategy number 7. The medical expense deduction that is larger than most seniors realize and that is being missed on thousands of returns filed every year. Seniors can benefit from higher standard deductions, medical expense deductions, charitable giving strategies, and retirement income exclusions. Retirement does not eliminate tax deductions. Medical expenses that exceed 7.5% of your adjusted gross income are deductible if you itemize. For a senior with $30,000 in adjusted gross income, that threshold is $2,250. Every dollar of qualifying medical expense above that threshold is deductible. Qualifying expenses include Medicare premiums, including Part B, Part D, and Medicare supplement premiums, prescription costs, dental work, vision care, hearing aids, medical transportation, and long-term care insurance premiums up to age-based limits. Social Security Administration. Most seniors tracking their medical costs informally and estimating at tax time are underreporting this deduction significantly. A documented record of every qualifying medical expense throughout the year, receipts, insurance statements, pharmacy records, produces a deduction total that is almost always larger than an estimate. And a larger medical expense deduction reduces adjusted gross income, which reduces the combined income calculation, which reduces or eliminates the taxation of Social Security benefits. Every dollar of medical expense deduction has a multiplier effect on your overall tax situation when it affects Social Security taxation simultaneously. Now here is the 6-minute mark. The combination of 3 specific strategies that can legally reduce a senior's federal tax bill to zero, and that most tax preparers are not building unless the client asks specifically. A married couple, both 65 or older, who qualify for the temporary senior deduction in 2026 will not pay a penny of federal income tax until their gross income exceeds $47,500. That is the base. Strategy 1, the $6,000 senior bonus deduction, is already built into that number. Now layer strategy 4 on top. A qualified charitable distribution of $10,000 from an IRA, satisfying part of the RMD requirement, reduces adjusted gross income by $10,000. Combined income for Social Security taxation purposes drops below the threshold where benefits become taxable. Strategy 7. Documented medical expenses above the 7.5% threshold produces an itemized deduction that may exceed the already enhanced standard deduction for seniors with significant healthcare costs. Capital Skyline. 3 strategies, applied together in the right sequence for the right senior in the right income range. The result is a federal tax bill of zero on an income that includes Social Security, pension distributions, and IRA withdrawals. Legally. Documented. Confirmed by IRS published guidelines. And available right now to every senior who takes the time to understand how the strategies interact before their return is filed. Here is exactly what you do right now. Calculate your total 2026 income, Social Security, pension, IRA distributions, any wages, any investment income. Apply the standard deduction for your filing status. Add the age-based additional deduction. Add the $6,000 senior bonus deduction if you are 65 or older. Calculate your combined income for Social Security taxation. Identify whether your income falls below the thresholds where Social Security becomes taxable. Then contact a tax professional and ask specifically about qualified charitable distributions, Roth conversion optimization, and documented medical expense deductions for your specific situation. For tax years 2026 and beyond, older individuals may want to focus on how to stay within the deduction's income limits. Individuals who are age 65 and up and still working may be able to reduce their taxable income by contributing to a retirement plan. AIU Web. If you live in a high-tax state, run the itemized versus standard deduction comparison with the new $40,000 SALT cap before assuming the standard deduction is still the right choice. That comparison may have changed significantly in your favor this year. If your 2025 return was already filed without the $6,000 senior bonus deduction, contact a tax professional about filing an amended return. The window is open, the money is recoverable, and it is your money. One final thing. There are people online right now selling courses and systems claiming to have secret methods that allow seniors to pay zero taxes legally through strategies the IRS does not want you to know about. Every strategy that legally reduces your taxes is already published in the IRS tax code. There are no secrets. There are no hidden methods. What exists is a tax code that contains specific provisions designed to reduce the tax burden on seniors and retirees. Provisions that are documented, confirmed, and available to anyone who knows to ask for them. The strategies we covered today are those provisions. Use them. And if a course is charging you $97 for information that is already published free on irs.gov, save your money. Are you currently working with a tax professional who is applying all 7 of these strategies to your 2026 tax situation? Or are you handling your taxes yourself and wondering whether you are missing deductions you are entitled to? Drop your situation in the comments right now and tell us your city and state. Like this video right now if any of these 7 strategies was new information for you today. Share it with every senior in your family and your community, because the deduction that the person you share this with missed on their 2025 return is a deduction they can still recover through an amended filing. And subscribe right now so the next tax investigation reaches you before your next filing deadline closes. What we covered today is confirmed by the IRS, Fidelity, Kiplinger, CNBC, Smart Asset, and Nationwide Financial published tax guidance for 2026. More investigations are coming. The system has rules. You deserve to know what they are. Take care of yourself.